Governor Polaz's hawkish tilt has certainly rocked the credit markets, leaving Canadian bond traders on edge. The yield on Canada's two-year government debt shot above 1% overnight, making it the worst performer among its short-dated peers. The same pain can be felt across the whole yield curve, with the benchmark 10 years jumping the most since March. How should investors be playing the credit markets in a rising rate environment? Andy Nasr is a portfolio manager at Sentry Investments. Andy, good to have you here. So why don't we start by just getting your take on the odds of a July hike? Do you think that the market is getting ahead of itself here?
Well, I think it's priced in. The Bank of Canada probably takes it if the bond market's expecting it. So we probably do get a hike in July. I'm not sure how many more hikes we're going to get after that, because I think in many respects, monetary policy in Canada has to strike a balance between trying to curb inflation and credit growth and yet still maintain economic growth. And I think that households are heavily indebted. If rates move up too quickly, especially in the absence of synchronized economic growth, then we're going to have a problem.
So are we talking one and done, at least for the time being?
I think we'll take July. I think the rest of the hikes, if there are any, for the remainder of this year and looking into next year, largely depend on the underlying health of the U.S. economy and the global economy. It's very difficult, given that central banks have had somewhat coordinated action since the global financial crisis, to envision one central bank or two central banks standing alone having hawkish policies when everybody else is still accommodative.
So if we do see this July rate hike, do we think that we may see some investor wariness in the yield curve?
So it's interesting because the Fed has raised rates and we've seen the short end move up a lot and the long end hasn't really moved up. It's actually gone down year to date. So arguably you could expect maybe something similar to happen in Canada. And I think there's several factors that have contributed to the long end of the curve declining in the United States. First and foremost, year to date, we've seen Treasury issuance decline as the Treasury and really the U.S. government contends with the debt ceiling. On top of that, we've had a slight reduction in inflation expectations, given that we've had such euphoria after the U.S. election, and there was a lot of content and optimism surrounding fiscal stimulus that seems to have faded. And I think that those two things really have depressed the long end of the curve, and you could possibly see some issues with respect to interest rates in Canada moving up, but not moving up all that much.
So taking into account your view that you don't think the Bank of Canada is going to be too aggressive over the next 12 to 18 months, how do we play this risk of a rising rate environment in the credit markets?
Well, so it's an interesting question. You know, in our view, diversification makes a lot of sense despite the fact that we've seen interest rates go down, equity markets go up. It looks like correlations are somewhat higher than they should be. I think diversification makes sense in the sense that you probably still want to have some fixed income exposure. So we wouldn't just turn away from fixed income given that interest rates could go up. I think in many cases you want to focus on duration and you want to focus on credit quality, and in our view you should still have exposure to corporate credit versus sovereign credit, and that's what we've done in a lot of our diversified mandates, with a particular emphasis on high yield and investment grade, a slight preference toward investment grade if you tend to be a little bit more of a risk averse investor. So there's still some opportunity there, provided you're picking the right issuers.
And do you like the international look right now versus Canada?
From an equity perspective, certainly. So we're still overweight equities relative to fixed income. And again, equities are just a much better hedge against rising interest rates and rising inflation, and that's our expectation going forward. However, within equities, we tend to be overweight the United States and international. Within international, it's specific emphasis on European issuers, where we think there are several tailwinds that will result in above average capital appreciation potential, including the potential for the ECB to taper, rising rates to force money into equities, and a cyclical rebound in earnings, which are about 40% lower than they were in 2007.
And before we let you go, I want to pull up a chart. We're seeing Canadian corporate debt performing pretty well this year, and this chart that I want to pull up shows the spreads narrowing. With spreads so low, do you still like that area?
So spreads are low in Canada, they're low in the US as well, and in our view, it's likely that spreads could remain low for the foreseeable future. So as an example, if you were to look at investment grade spreads, which I said we favor, the investment grade sector, you'll see that spreads are about 40 basis points lower than they have been in the last 20 years. They're about 1.2% on an option adjusted basis. And to us, that says that the market is richly valued. But if you were to look at M&A activities as an example and global investment grade issuance, you'll see they're both down about mid-single digits in the first half of 2017 compared to the first half of 2016. In other words, there's less supply, which is supporting lower spreads. And if some of the things in the United States happen that could potentially improve the cost of capital for companies, like lower taxes or even repatriation of corporate profits, well, that potentially means you're going to have even less supply, which would support spreads remaining relatively low. And we actively manage the spread risk by looking at duration and credit quality.